Hello and welcome. Today we are here with John Sharp, the founder of Hatcher Plus. Hatcher Plus is, in my opinion, one of the most exciting venture capital vehicles out there in the world, very innovative. And John has had extremely interesting experiences in his background in the startup world and transitioned to venture capital. John, thank you for being here.
Alex, it's great to be here with you.
As I already introduced you, but still, I think it would be super exciting to hear what your background is. What led you to become a venture capitalist?
That's a very interesting question because I'm not sure that anyone starts out when they're sort of like in their youth and says, well, I'm going to be a venture capitalist. Yeah, that's it's sort of not when you leave school sort of with the eventual destination. I think what happened is, like a lot of people, I made a little bit of money along the way as an entrepreneur. And you sort of you're led then by two motivations. You want to obviously make that money, make more money. You want to invest, with the purpose of generating more capital. And if you're familiar with the venture model, it's a very good asset class if you know what you're doing. So that's it. But also there's that sort of feeling of wanting to be still involved in the startup community and still involved with people that have ideas that maybe they're trying to get out into the world. And there's this feeling that maybe you can be of some assistance to making that happen. That's not quite our model, as you know, in the new fund. But it's certainly a motivating factor as to why you would go from being an entrepreneur to a venture guy. I have to say, being a venture guy is about the funnest thing I can imagine doing in the world. It's a pretty awesome occupation, and so it feels like it's a nice place to end up after a few decades working in business.
Speaking about working in business, can you tell us a little bit about your startup experience or your tech experience yourself? I know you have been running super exciting companies before.
I have been always very lucky because I've been running entrepreneurial and venture-backed companies for a bit over 25 years. So I had I had a lot of experience with sort of working on the other side of the table of going in and pitching a VC and then having them go through the diligence process and having them validate what we're doing as a company. And so I got very familiar with that. I raised a bunch of money as an entrepreneur and had a couple of successful exits and a couple of failures, as we all do as entrepreneurs. But along the way, gathered a lot of respect for the venture process. And so when I moved back to Singapore, it felt like quite a natural thing for me to start doing some angel investing. And it was through the process of doing angel investing that I ended up as a partner with a number of other angels. There's a bit over 40 of us in a firm that made investments in a number of startups. And we ideated most of these startups. We would think, let's do a data backup and storage company. Let's do a payment gateway. In the Middle East, let's create, in the case of Hatcher Plus, a new innovative model for venture. So we would ideate many of the companies that we invested in. So it was more of a sort of accelerator / venture builder setup. But what I found over the course of several years of running this let's just call it a venture fund because it's something people can relate to, I found it was a bit like every day I was turning up and I was going to the Monte Carlo casino just down the road from you. I was putting bets, on a bunch of tables, hoping that I could come back in 10 years and there would be pots of money there. And that whole sort of methodology didn't really sit very well with me because I just had the whole time this feeling that I was trying to beat the odds. And so towards the end of our first fund, I started just ask a very basic question, and that is, what are the odds? If I know what the odds are of success, then I have an idea of how high that hurdle is and what I need to do potentially to beat them. So the first thing we did at the end of the first fund is we just went and looked at a whole bunch of industry data and tried to make sense of it and figure out what are the actual odds that a startup is going to walk into AKX Capital and you're going to invest in them, and then that company is going to go on and become a billion-dollar exit. So that was the first sort of step that we took in trying to figure out what an evolved model would look like.
Okay, and that brought you then to setting up Hatcher Plus, right? But like that's a data-driven venture capital firm.
And a lot of people kind of misunderstand that, and they think that we're using robots to sort of select startups, and it's really not like that. There's actually a blog on my website entitled AI versus Human Reasoning in Venture. And we go into some detail and explain what we think AI is good at and what we think humans are great at. And what we think AI is good at is establishing models, understanding the odds, creating the possibilities for success algorithmically. So we use AI, and I must give full credit to my partner Dan Hookturp here. We use AI to basically create a portfolio construction theory that we think can have a predictable output. So the way we went about that is we actually downloaded 600,000 deals from a whole range of data vendors all around the world and a few friends. And what we did is we created 4 billion portfolios over the space of 2 years after cleaning up the data. We just went at it and basically created 4 billion virtual VCs, where we took all of these deals and we created all of these different kinds of portfolios, like a 50 company agri-tech portfolio in India, or a 200 company advertising technology portfolio in Europe. And so we would study all of these portfolios and look at all the outcomes. And as we were studying this, we kind of had this idea that it would result in all of these amazing strategies that we could then implement across 20 or 30 funds. And that didn't happen. What happened was one output became immediately obvious to us. And it also supported a lot of what we'd seen going on in traditional venture capital companies. And the output was very simple. If you invest in a very large scale portfolio, like 500 companies and up, you will have a predictable outcome. And the reason for that is very, very simple. Basically, 1 in every 100 seed stage companies will go on to become a billion-dollar exit. If you invest in 1,000 companies, you can statistically expect 10 of those companies to go on and have billion-dollar exits. You only need 5 of them to have a 4 or 5x, 5 good ones to have a 4 or 5x result for your fund. And the more that we looked into this model, the more that we just realized that diversification was really quite key. It wasn't necessary to specialize in a particular location or a particular industry. It was quite important to go early because the returns available from earlier investment, as a friend of mine says, that's finance 101. Whether it's a house or a venture capital company, buy early. So we just discovered that a very large portfolio of early stage companies would present a more predictable result to us and therefore to investors in our fund. So that's how we got to this premise. Now, the logistics of investing in 1,000 companies and monitoring them in a portfolio is a whole other area, because as soon as we got this result, we suddenly realized that, oh my God, what we have here is it's no longer a math challenge. We know what the math tells us that we should do. What it is now a logistical challenge. How on earth are we going to go out and find 1,000 companies that are investable and construct a portfolio of that size? So that became the new challenge in what we're doing.
And how did you overcome that challenge? Because that's a real difficult one. VC is a very human-driven.
Yeah, correct. Well, look, the first thing we did is we got in contact with people that had done it before. People like Dave McClure at 500 Startups, the folks at YC, the folks at Plug and Play, and so we actually went and met with as many people would meet with us, and we'd say, look, we've got this problem. We think that our model is showing that we need to do 1,000 investments or invest in 1,000 companies. It's probably closer to 2,000 investments with the follow-on funding. And it was quite interesting. A lot of people had some very manual, very people-intensive approaches to solving that problem. And we didn't really want to go down that path because for us, it just looked like a huge expense and non-scalable. And what we found so interesting about the process that happened once we started tackling this logistical issue is what you expect when you walk in and you meet with a venture capital company is you expect a partner that is really has some really strong skill sets. And one of those skill sets is going to be how you scale companies, because that's why as a startup you want to partner with a VC fund, because there's smart people there that understand how to scale companies and get that growing off the hook. The second thing that we expected there was we expected to find people that were super innovative, and they'd be saying, look, have you thought about doing this? Have you thought about doing that? Because that's, again, what venture partners do in the context of many of the companies they invest in. But what we found instead is there appeared to be a bit of a blind spot in venture where all of these super smart, super connected, really great guys had really not turned their vision internally to their own organization, and they hadn't really thought much, with some exceptions, about how they would scale their operations or how they could innovate their operations to incorporate data, technology, blockchain, all of these emerging approaches. And so that became quite fascinating. We ended up getting almost no guidance from anyone that we're talking to. It's just sort of like, good luck with that. Let us know when you've got that figured out. So we had to kind of figure it out ourselves. And we had a couple of lucky breaks. We'd been working on a sort of process automation system for a couple of years leading up to that. So what we did is we went out, raised a bunch of money, raised $10 million. We started scaling that technology so that it would support, if you're investing in 1 out of every 100 companies, of course, you have to look at 1,000 companies to find 10, right, that are any good. So it had to support this massive deal flow. It had to support multi-language because we wanted to be globally diversified. A whole number of currencies, like 50 currencies was what we estimated. And it had to be data-driven to the point where we could do what we call anti-selection. So that if you were applying to a medical device accelerator and you're looking for $1 million, and you're looking for $1 million and they only give $100,000 and actually only invest in advertising technology, we wanted to find the mismatches and the things that were off mandate first. So what we eventually established is a really nice set of technologies that enable people to apply through us or through one of our accelerator partners or VC partners. And what we do is we then match up and see how closely the applicant is matching their mandate. And then we isolate the top 10%. We say, look, if you're only going to invest in 10% of this 10%, this is the group that you should look at, and forget the other 90% because they're just not on your mandate. So that was one way that we found to scale the venture process to where we could see an awful lot of deals, but also play a useful role with our partners. So we now have partnerships with about 20 accelerators around the world. By the end of this coming year, we expect to see about 30,000 deals through our platform a year. We think that's probably about a third of what's out there in terms of seriously investable deals. And we'd like to get somewhere between a third and a half of the global deal flow. We'd like to get some visibility on that within the next 2 to 3 years. So basically, to cut a long story short, we went into this second phase of what we're doing, basically just ripping up the rule book and saying, if we wanted to be innovative in venture, if we wanted to figure out how to scale venture, how would we solve for those two requirements? And then how would we create a model whereby how could we create technology in support of the output of the first model where we know we can create predictable returns if the portfolio is big enough. So that was how we evolved this model. And we just got a little bit lucky in that we had the right person from the data science standpoint in Dan Hookturp. My background is in process automation as well, so I took over the nuts and bolts piece of the business. And between the two of us, we were able to code together something that seems to have worked to help us expand into this new area. But the third thing that's actually happened is in the last 12 months, there's been a massive growing acceptance that things are changing in venture. We are going to be more data-driven. There's going to be a lot more process automation. People do want to start thinking globally rather than locally. And so there's been quite a shift in our direction. Oh, and of course, COVID has created this whole virtual environment that we now inhabit, and that includes accelerators. So guys that would have had a building in downtown Monaco now have a virtual offering, And that is a two-edged sword. It means that the cost that they're paying for rent there is no longer a great thing to be paying. But on the plus side, it means they can reach out to people all around the world. And we spoke to one accelerator yesterday, for example, in Australia. These guys were previously just operating out of one city. And with COVID now, they're operating out of 7 cities, including Auckland, which is fantastic. So it's actually transformed their business to be quite a positive out of something that's been, quite a mixed event.
Yeah, I think that's a really nice ending to wrap up overall our talk. Maybe last question here. Where do you see venture going now really in the next few months and weeks or years even, besides the data-driven part? Do you see there any changes or what's going to happen next?
Massive positive changes. If you look at what happened after the last big crisis we had, which was the financial crisis, the global financial crisis, at that point, a lot of people were very down on what would happen in venture and just generally around the world. We're all wondering if we're even going to survive. The output of that event was 5 to 6 years later, we had the biggest crop of billion-dollar exits that's probably ever been. And it's continued to this day, and we've seen this massive, never-ending bull market up until this point. So it wasn't all gloom and doom. It was a gradual return to normalcy on the sort of public equities level, and one may argue, far beyond that. But what the fascinating thing for me is that in the venture world, there were many innovations that happened because of the global financial crisis. Before the GFC, no one would have rented out the back seat of their car. No one would have rented out their holiday house via Airbnb or rented out their car by Uber. These two absolutely amazing business models happened because of the global financial crisis, and billions of dollars worth of value were created out of a crisis. Same thing is happening right now. What you're seeing in with COVID is digitization is now being enforced to companies. Technologies like Zoom and 1,000 other technologies, productivity-based technologies, are just absolutely exploding, and you've got regulations that used to take we used to take 5 years to approve a vaccine. Now it's 5 months or even 5 weeks, it seems, in some cases. So you've got this massive compression of the time needed to create regulatory approvals for things like fintech, because no one wants to touch money anymore. So digital currency, digital payment systems, massive adoption is going to happen in all of those areas, along with everything that's happening in medtech and digitization of some of these business processes that was long overdue. So my personal prediction is I think we're in for 5 to 7 years of extremely strong growth in venture. I think it's going to be an amazing time for people that invest in these technologies. And even if we do start to see some kind of correction in the public markets, I think that we've already proven that there's quite a non-correlation going on between venture and public markets. I think you'll see that continue. I don't think it really matters what the public markets do in the next year or 2 years or 2 months. Venture is going to do extremely well out of the next 5 to 7 years.
Actually, now you raised another question. I'm sorry to ask another one, but exactly how has the current, let's say, development changed also the LP world? Are there more LPs now looking into venture, in your opinion? And how are they looking into it? Because I know you were a guy who was nonstop on the plane. I called you one day, you were in Singapore, the next day you were in Silicon Valley, and in between you stopped by here in Monaco. So how has that been actually changing, and or is it the same in your opinion?
Look, at a personal level, I do miss that. I miss hanging out with you in Monaco. I miss hanging out with my friends in Dubai or Riyadh, and that's just at a personal level, right? But at a business level, I find that what's happened on Zoom is we're all much more relaxed and productive on Zoom or on video conferences than we ever were before. I think video conferencing before had a kind of stifled area of it was kind of almost a formal sort of thing. And now I find that I find myself having video conferences with people that would not have been on a video conference 2 years ago. So there is a much wider acceptance of video conferencing, I think, as a tool. And going forward, I think, yes, we'll still travel because we still like to see our friends. But I think there's going to be a lot more business done like this. And And I do actually find Zoom, I have to say, Zoom is much more efficient than lunch, really. If you're talking about a complex subject and you can flip to some slides and you can talk about that and share some data, I actually find Zoom calls to be a highly productive way to hold a meeting about complex subjects like venture capital. So, yeah, I actually think it's going to be a mix going forward, isn't it? We'll be doing some traveling because we do enjoy doing that, but it's going to be much more of a combination of those two things. So the Zoom price, I think, should stay around it where it is or keep going up, I'm pretty sure.
All right, fantastic. Then thank you, John, for being here with us. It was a fantastic talk. Thanks for all the information. It was super interesting. I hope to see you soon again, hopefully in person, either in Singapore or Monaco, and if not, on a Zoom call. Thank you. Bye-bye.
Thanks a lot, Alex.
Bye, John.
Cheers.